Hey everyone, welcome to the In Your Business podcast, your go-to leadership, business, and finance podcast. I'm your host, Michael Sayre. This podcast is for you if you're a business owner, if you're an executive or an entrepreneur. CUI Wealth Management produces this podcast. CUI Wealth Management is a financial advising firm that provides 401k services and wealth management services to executives and entrepreneurs. If you get value out of this podcast, please like, subscribe, and share this with others. Today, I wanted to talk about toxic behavioral finance tendencies that can impact your 401k savings and your investment strategies. We're going to be going over a couple things today. We're going to talk about what is behavioral finance, some of the common behavioral financial tendencies and fallacies that can really impact our finances, and then strategies to navigate behavioral finance and to overcome these challenges. Before we get into all of that, I'd like to talk about an event that we have going on. We are going to be doing a SHRM CE or continuing education webinar this month. It's going to take place February 29th at 3 p.m. Mountain Standard Time. We have a VP from Fidelity who's going to be sharing the results of their annual survey that looks at different 401k trends from different plan sponsors. And this is going to provide 1 hour of CE. And I will provide a link here below. And if you want to get the CE done, make sure you attend. If you are an HR person, we'd love to have you there. If you're not an HR person, make sure you share that information to your HR professionals within your organization. So let's talk a little bit about what behavioral finance is. Let's start by defining it. Behavioral finance is, so back in the day, people used to think that everybody made rational decisions, but now we know that decisions are not always made rationally. So behavioral finance combines psychology and economics to gain insight into individuals and their investment behavior. So unlike traditional financial theories that assumed everybody always acted rationally to maximize the utility, their utility and build wealth, behavioral finance considers cognitive biases. It considers emotions and mental shortcuts that sometimes result in irrational decision-making that can really impact our finances. We're not going to go through a complete list of behavioral financial tendencies. There's a lot, but we will talk about some of the common things that we see when it pertains to finances. So let's jump right in. Before I get into the first cognitive bias, I want to kind of give a little bit of background. Back in the day, if you wanted to communicate with someone, you had to do it word of mouth. And then we learned how to write, right? And people were able to send things eventually via letter, and you'd have horse and buggy that took the mail to different places. And then we came to a point in our in existence where we started to get a newspaper. And in the 90s, that was a popular thing. You know, you could see your where finances were as you read the newspaper in the morning. And now with the internet, you can see exactly how things are doing on a regular basis. You can see it through the day. You can see how financial markets are doing. But you also get to see a lot of stuff that you're not asking for. So for example, you'll see people talk about finances on social media. You'll see the market changes on the news when you watch that. So the reason I bring this up is because people sometimes have a tendency to follow the crowd. This is what's called herding behavior, not hurting people, but herding as in herding cattle, herding sheep. So following the herd. And you don't want to be the person that's following the herd if the person that's leading the herd doesn't know what they're talking about. And that is something that is important to recognize as you are making financial decisions. There is this fear of missing out. There's a fear that we don't want to miss out on the next big thing. And sometimes we take the mental shortcut of not doing the research that we need to make sure we're actually making a decision that is worthwhile. So here's what you need to take into consideration, that following the herd, it can lead to groupthink. It can lead to fear of missing out. And that's how market bubbles and crashes often occur, is because of that herd mentality. The next thing I want to talk about is anchoring. Anchoring bias is when individuals rely too much on the first bit of information they encounter when making decisions. So think about this. Sometimes you may have seen someone that is in a relationship and you're like, why are they in that relationship? They don't get treated well. And perhaps they got treated well at the beginning, and that individual is no longer recognizing what's going on, and they are using that first interaction they had with that person they're dating as their yardstick or their measuring stick for all the other interactions. It's the same reason why when you're growing up, your parents always say to smile, to look people in the eyes, to dress well. And that's because first impressions can have a lasting effect, and people tend to anchor towards that first impression they get, and they neglect information that they get, like the new information that comes around. That's something that happens in the investment world too. Sometimes people get so caught up on the idea of a specific investment type or an investment strategy that things may have changed and it may not make sense to continue doing that. But because that was the first bit of information they got, they anchor to that, they hold on to that information, and they don't let it go. So you don't want to be that person that is making bad financial decisions, that is making poor financial decisions and crippling your long-term financial situation just because you are holding on to things that are no longer relevant or that have been debunked. The next thing I want to talk about is loss aversion. This is a bias that is really common because we tend to feel the pain of loss 2 to 3 times more than we feel the pleasure of gains. So I see this all the time when we talk to people and they're looking at their statement. If their financial statement with their investments is down just a little bit, people don't love to see their investment statements down. But if they've done spectacular, they are not going to go and celebrate the same way. We don't notice that as much as the pain that we feel when things are not going well. So because of this, what happens is sometimes people will not invest in enough risk, not a portfolio that's risky enough for them to get the type of returns they need to really make it worth their while. We get so focused on the risk of market risks that we forget about other types of risks. So for example, inflation risk. The risk of inflation is that costs of goods and services go up over time, and you don't want to be in a position where you can't afford to retire, you can't afford to live later on because you were too conservative and you didn't have enough investment return to overcome that inflation, the inflation that's going on. Another fallacy that is common that I see is the gambler's fallacy. Think about it like this. If I am flipping a coin and I flipped it 50 times, and let's say it's landed on heads every single time out of those 50 coin flips, what is the probability that it's going to land on heads again? This is a common fallacy because the past events don't have an influence on the future events. So I still have a 50-50 chance of having that coin land on heads or tails. So the gambler's fallacy is the belief that future random events are influenced by the past events in a way that balances out the previous outcomes, even if there's no logical reason for such an influence. Pay attention to that when you're looking at your investments. Sometimes people take a look at a stock or a fund and they'll be like, yeah, this is definitely going to break out and it's definitely going to do super well because it's done poorly for the last little while. So that cycle is going to be influenced by the past performance. Or they'll look at the past performance only and they'll be like, hey, this thing is always going up. It's always been going up and it's always going to go up. And they don't realize that what's happened in the past doesn't have an influence on the performance of that investment. So try to steer clear of some of these fallacies. We'll steer clear of all of them, but these are some of the common ones that I see. So let's talk about some ways that you can navigate these behavioral financial tendencies. The first thing that you need to do is be aware. Being aware of potential behavioral biases and cognitive biases can be extremely helpful in overcoming them because biases are natural tendencies. They're things that we all possess and they impact our decision-making process significantly. However, if you recognize those biases and if you're conscious and see those potential biases come about, then you can avoid making those mistakes. That's why we want to shed light on these types of things. And the way that you can get better at recognizing those biases is becoming more educated on them. And like I said before, we aren't going to go over everything today because we're trying to keep these podcasts pretty short and sweet, but we do have that link to a blog post that we recently did talking about more of these cognitive biases and going into more detail. And keep in mind that we can do additional podcasts like this in the future, explaining more of that information. But hopefully this at least gives you some thoughts and some ideas. Another way that you can combat these cognitive biases is a long-term perspective. So think about this. Here's another cognitive bias. There's the sunk cost fallacy, where individuals continue to invest over time or invest time, money, or other resources into a project or activity, even when it's no longer rational to do that. And that's because sometimes people, they think that they have to continue to invest in the time because of all the time they've already put into that. So sometimes people hold on to something, an investment that they shouldn't be holding on to, and instead of cutting their loss because they don't want to have the pain of having actually realized that loss. But here's the thing is, when you look at short term, it's really easy to get lost in the numbers. You see the day to day, you see a week where the market takes a really big hit, and it's hard for us as humans to take a step back and see the long term. It can be crippling to our finances when we make those gut reactions to markets. So for example, some people will see a short blip in the market, and their mind will go back to the dot-com bubble or other financial situations where the market took a big hit. And so they'll want to avoid that altogether. But if you look at a 30-year time horizon on most major indices, you'll see that those short blips, they're hard to even recognize in the long term when you look at a full perspective. So as you're making decisions, make sure that those decisions are long-term investment decisions, that they are taking into account that you're probably not going to go and just try to do a knee-jerk type of investment decision just to follow the crowd. Another thing that you can do to avoid these behavioral biases is to get an outside perspective. Have you ever talked to someone and asked for their opinion? And when they give you their viewpoint, all of a sudden everything becomes clear and you know exactly what you're supposed to do. It's easy for us as human beings to get caught up in our own thoughts and processes and not to see the blind spots. And not have that long-term perspective that we need for our long-term financial success. And this is one of the reasons why a financial advisor that is qualified and has experience can be such a great asset to individuals, is because those advisors, if they have experience, it's not their first time seeing things, and they can see those blind spots and help you make good investment choices to hit those long-term goals. For those of you who are involved in HR or who are business owners and looking to help have a more productive staff, understanding these cognitive biases and behavioral biases can really help those individuals. So what we recommend is, if you are doing a financial wellness program or a financial education program for your company, to include this type of a topic for those individuals in your company, for those employees, because there are a lot of stresses that cause people to not pay attention to their work, right? They're going to be more productive at work if they're not spending half of their brain capacity thinking about their financial struggles. So it's important to have good, solid financial wellness programs to help avoid some of that. Well, this is coming to the end of our podcast. Thank you for joining us. I hope this has been helpful. I hope you feel more confident in understanding behavioral tendencies and cognitive biases that lead to poor financial outcomes, and that you have a good idea of how to overcome those biases. If you gained any value from this podcast episode, please like it, share it, subscribe. If you are a business owner looking for an advisor who works with and understands wealth management for entrepreneurs, please reach out to us. If you like a second opinion on your 401k for your company, please reach out to us. We'd love to give you a second opinion on that. Thanks for joining the In Your Business podcast, your go-to podcast for leadership, business, and finance. We'll see you next time.